Hello! In this video, we'll consider a checklist approach to corporate property distributions. Now, Section 317 of the Internal Revenue Code defines property as money, securities, and any other property except stock in the corporation. Stock in the corporation deals with stock distributions, which is another topic. Now, the first step we need to consider in this checklist is to analyze the tax consequences of the distribution to the corporation distributing the property. Second is to adjust the current earnings and profits to the corporation distributing the property. Third, consider the tax consequences of the distribution to the shareholder receiving the property. And fourth, adjust the accumulated earnings and profits for the corporation distributing the property to roll over that balance the next year. Now, if these steps are done out of order, it will affect amounts. So it's important to consider all four steps in order. Let's consider the first step, the consequences to the distributing corporation. If the corporation distributes property, the corporation must recognize any appreciated amount on that property. So this is when the fair market value of the property exceeds the adjusted basis of the property. It's best to think of it as the corporation is selling it to a third party. Calculate that gain. The character of the gain will be determined just as if the property was being sold to a third party. So characterization, like that, selling to a third party. Now, if the corporation has lost property it's distributing, which is the adjusted basis is greater than the fair market value, the loss cannot be recognized. This is important because this is an anti-abuse rule. What corporations and shareholders were doing is they were specifically distributing out lost property to the shareholders so the shareholders could take advantage of the losses. Recall that a C corporation, the individual owner cannot utilize the loss outside of the corporation. The loss must be utilized within the corporation. Now, if the distributed property is subject to liability or the shareholder assumes liability of the distributing corporation in connection with the distribution, the fair market value is treated as not less than the amount of the liability. So the idea here is you pick the greater of the fair market value or the liability when you're calculating the gain with respect to the corporation. Now, in the second step, we'll consider the adjustment for corporate current earnings and profits from step one. Gains create potential earnings and profits adjustments that the corporation must adjust for. Now, remember that a loss cannot be recognized in step one, so we don't have to worry about decreasing for earnings and profits. But gains do. Gains increase earnings and profits. Now, it's also important to note taxes will decrease earnings and profits, so you should net out the two numbers. Net of taxes on the amount, because gains create more taxes. In step three, we consider the consequences to the shareholder receiving the distribution. So the first two steps dealt with the corporation that was distributing the property, and the third step deals specifically with the shareholder. Now, there's 5 steps within step 3 to consider. The first is to calculate the amount of the distribution under section 301B. The formula is the cash received by the shareholder plus the fair market value at the date of distribution of any property received minus any liabilities that the shareholder assumes. Now, this amount can never be negative. How would it ever be negative? What if the liabilities exceed the fair market value of the property? Now, in that case, it's almost never that the shareholder would actually take the property, but it's possible. The amount cannot be negative. There's a 3-tier waterfall with respect to the tax consequences of the amount of the distribution. The distribution we first consider what is the amount of the dividend. So we need to classify what exactly dividend means. Whatever's left then goes down the waterfall to return of capital, which we look at the adjusted basis. And finally, whatever amount is in excess of basis, we consider capital gain distribution, where we look how long the stock was held, and it'll be long-term capital gain or short-term capital gain. In step 2, we're considering how much of the distribution is a dividend. Now, a dividend is defined in Code Section 316 to the extent of earnings and profits of a corporation. Now, that includes current and accumulated earnings and profits. In this checklist, we're talking about different situations where current EMP and accumulated EMP can have different scenarios. So there's really 4 different possibilities. Let's call this current and this accumulated. You can have positive current and positive accumulated. You can have positive current and negative accumulated. You can have negative current and positive accumulated, and you can have negative current and negative accumulated. Now, it's possible that even when you have both positive, you won't have enough earnings and profits to cover the full amount of the distribution. So there's different scenarios within each one. Now, there are special rules in using accumulated and current earnings and profits to calculate dividends under Section 301. Because in those 4 different scenarios where we have positive and negative, it's possible we can have different outcomes. We just simply don't add them together and say, okay, that's the amount of earnings and profits we have, and that's it. No. We always use current earnings and profits before accumulated earnings and profits. So if you have a distribution during a year and you have negative E&P, so if you have current E&P that's positive and accumulated E&P that's negative, and let's say the accumulated E&P is $100,000 and the current E&P is $10,000, well, that's negative $90,000 total. So you say, well, we don't have earnings and profits. That's not how it works. You have to look at current E&P first. When considering current E&P, the idea is that current E&P is a better indicator of how the corporation is doing in the current year to classify the amount as an actual dividend with respect to what was made. Now, current E&P is not reduced by a deficit in accumulated E&P when looking at distributions during the year. So as I mentioned in my example, we don't net the two numbers. Current E&P is determined at year end regardless of when the distribution was made, or else you could avoid being taxed as a dividend by gaming your distributions as a shareholder. The idea is that if you have multiple distributions during the year, you have to prorate those throughout the year, and you do that at the end of the year. Now, if the total distributions exceed current E&P, then the portion of each distribution is prorated based on throughout the year. So here's the formula. You consider the total current distribution during the year. April, we had a distribution of $6,000. December, we had a distribution of $4,000. And let's say that we have current E&P of $5,000. Under our current E&P analysis, $3,000 goes to April and $2,000 to December because of our formula. Now, if we have accumulated E&P of $1,000, then that $1,000 will go all to April because it's FIFO, first in, first out. We go by the first distributions made, so April is first in time. Versus current E&P, again, we consider in total. Now, if current E&P is negative and accumulated E&P is positive, then we do have to net with respect to the numbers. So there's 2 rules here. The first rule is a general rule, which we prorate the negative current E&P to the time of the distribution. So if we have a distribution on April 1st, and we have 10,000 accumulated earnings and profits and negative 20,000 current earnings and profits, then we take 3 months, 3 out of 12, which is January, February, March, times 20,000, that's negative $5,000. And we net that with the accumulated earnings and profits on that date, and there's 5,000 positive E&P that can be utilized for that April 1st distribution, whatever amount it is. But if you have another distribution later on, you still have to prorate that negative current E&P. If you actually know that the negative E&P is attributable to a certain date, then it can all be utilized on that date. The general rule is more common. The specific rule is when you have a certain large transaction. So we're still in step 3. I know this is a long step. This is the longest step when we consider the consequences to the shareholder. So now that we've determined the amount of the earnings and profits, we can look at our waterfall. We calculated the distribution in step 1 of step 3. That's the amount. In step 2, we calculated the amount of earnings and profits. In step 3, now we can say, okay, what amount of our distribution is considered a dividend because now we have earnings and profits. After that, anything left over will be return of capital to the extent of our adjusted basis. Now, the adjusted basis of the stock will be reduced. The adjusted basis of the stock will be reduced after the transaction down to whatever it's left to. And this is important because if the shareholder sells his or her stock the next day, let's say, or in the future, this is going to affect the numbers. It's going to affect the amount of gain or loss that the shareholder is going to have as a result of selling the stock. And then finally, if there's anything beyond basis, we call that capital gain distribution. With capital gain distribution, we look at how long the stock was held by the shareholder. And we take into account Section 351 if that applied in tacking on and determining long-term capital gain. It's going to be capital because most shareholders are not going to be dealers in securities. Now, the adjusted basis of the property received by the shareholder is always fair market value. This is even true. This is even if the liability is greater than fair market value. Now, many commentators, academics, practitioners have written about this issue and how it just doesn't make any sense. Now, if you're a corporate shareholder, it's important to note that you might want a dividend received deduction, the DRD, Section 243. So it's preferable that you actually do get dividend treatment because, yes, right now we have qualified dividends for individual shareholders. So right now you're at preferential rates, but at one time we didn't have that. And it's possible that can go away in the future. So shareholders generally prefer to get down here the return of capital and capital gain distribution because that can get you the preferential items. That's historically. But again, right now we have preferential rates. But a corporate shareholder prefers a dividend because of the dividend received deduction, which is 70, 80, or 100% of the dividend is excluded from gross income. Now that we've completed step 3 and considered the consequences to the shareholder, the final consequences tie everything back to the corporate distributee. We have to consider what the corporation is going to roll over with respect to its accumulated earnings and profits. So remember, we talked about earnings and profits and how if there's current earnings and profits for the year and accumulated earnings and profits for the year, whether they're positive or negative, next year we're going to have to roll over accumulated earnings and profits. The accumulated earnings and profits from last year is the current earnings and profits from the previous year adjusted and rolled over. We start by taking accumulated earnings and profits that were given or calculated. We add or subtract the current E&P given, depending if it's negative or positive. Then we adjust for step 2 for the gain. Now, again, you have to net the tax consequences, but don't really worry about that in these basic examples. We subtract away the distribution amount that we calculated in step 3 to the shareholder. Whatever amount is considered distribution. Now, the general rule is that whatever amount is treated as a dividend, that's the amount we subtract away. Now, when we adjust those amounts, we get the accumulated earnings and profits for next year for the corporation, which is going to be important because we have to do this every year, calculate what amount is considered dividend with respect to the shareholder, and it affects everything. There's 2 exceptions to the general rule that the distribution amount is always going to be the dividend. Lost property, meaning when the adjusted basis is greater than the fair market value. If we have lost property, then the amount of the distribution will be the adjusted basis, not the fair market value. If we have liabilities, if the liabilities exceed the fair market value, which again, many of you are out there thinking, why would a shareholder ever take that property? Then the difference between these 2 amounts will be a positive adjustment when calculating the amount. So we'll actually have to add in for the liabilities. This concludes the consequences with respect to corporate distributions of property.